Talk about how you've seen the asset style, because in the, like you said, we met about 10 years ago. Whenever I was I've been dabbling my foot in this industry for a little while at that point in time, and it seems like back then it was buy the old rundown homes that had been rehabbed by whoever had purchased them during the, after the Great Recession ended and they could. And now it's kind of gone into the build to rent space for the investors who are, serious and building up their portfolios. Is that a shift that you've seen? Has it surprised you at all?
No, because I think the build to rent thing was always is always been a thing. The problem is there wasn't a lot of building going on. When you consider what happened after 2008, and then you see what happened with the construction piece of it that never really went back to the level of construction you had pre '08. And then you have COVID come in here and mess with it even more when it comes to supply line. Now all the supply chain is going towards building apartments. So build to rent is definitely, in my opinion, one of the better ways to go because you have a better quality asset that you then turn into a business, that you limit the amount of capital expenditures that you have. But at the same time, a really good remodel turnkey could also be just as good, if not better. Because sometimes, man, there's guys making a good living off of their TikToks and their Instagram and inspecting some of these builds, these new construction, because the quality in some places is just not there. So the fact that it's new doesn't mean that a client or a real estate investor can just take it for granted that it's a new home, so I should be in really good shape. What I tell them is this, and you get that scope of work of what it's going to take for them to build it. You get an inspector in there to take a look at the grounds and what they're doing, look and do the exact same type of inspections that a bank would do during draw periods. Understand everything that's going on. I've been preaching that for a very, very long time. It's amazing how many people fail to do that. And then they want to come back at me saying, "Hey, I bought a piece of crap, and you need to have some sort of uh, involvement here in the remedy." I told you what you should be doing. You chose not to. You, as a real estate investor, need to be very, very aware of everything that's going on. Just because it's new construction doesn't mean it's good construction.
Very, very true. That's one of the things that, we run our numbers and try to be as accurate as possible. I tell Grant we want to be the most trusted numbers in turnkey. And but so many investors, they go into these things with, you know, listening to the people who are building the homes or rehabbing the homes or not checking the numbers. And it's incredible to me that so many people are putting in 50, 80, $100,000 into a property and not even bothering to call up and check out the property taxes.
Mm-hmm.
Not even, talking to a property manager, before they do this, not vetting anything and just taking people's words for it, because that's makes me feel good on the inside, if they're listening to me. But on the other hand, it's your money, right? Kind of like what you were just saying. I mean, whatever, if it all goes downhill, there's really one main person to blame, and it's not the person who sold it to you.
Well, people, it's an inherent human thing. People want to have as little responsibility as possible for what happens in their life, but they want to have somebody else to point the finger at. That happens in everything, interpersonal relationship, business. If you're just an employee, you can have that issue, right? That is a human problem, and it's a condition that we have to try and see that we can overcome. As people involved with our real estate investors, instead of hoping that they're going to be that, we have to beat that into them. And I don't want to use the word beaten, but I mean, get my book. You'll understand why I use that word, because you have to change your nature. That is human nature. If you're going to be a real estate investor, you have to avoid it. Now, some people, their nature is to look at every single penny, right? That's a different group of people. There's some demographics, or not really demographic, but it's a cultural thing where they dig into the pennies really, really hard. And sometimes that can be a bad thing too, because or the over analysis that happens. But when you're talking about that is people that live and die by a pro forma. And let me tell you guys, pro forma, Aaron Chapman's opinion, is no Greek word for bullshit. It is not something that exists yet. That is somebody's best guess based upon their experience. Question is where is their experience from? Now, was it during the window of time we had, there's a lot of people that are real estate investors now, real estate investor coaches. There's people that are real estate investment lenders that say, hey, I'm experienced. They got in right after, say, 2015, 16, 17, they got in right around COVID or something, they're not experienced. I'm sorry, they have not seen enough cycles to understand what's happening out there. I've got a lot of contemporaries out there that got into this after 2015, 16, 17. Why would I know that? Because there was only three of us, literally three of us paving the path in 2012 up to about 2017. During that window, there's only three of us that were on all the stages or getting our butts kicked, trying to figure out how to get the banks to lend to us. And after we beat those walls down and paved those roads, it's amazing how many people jump on those roads with their rigs and say, I'm now on the experienced road, but they don't know what it took to pave that path. Now, only two of us are left back in the game from that time that has been doing this since the 2000s. Everybody else has been in it since way well after that, and unfortunately, they have yet to earn their chops. You, as a real estate investor, need to be careful who you're working with when it comes to earning your chops, especially on the lending piece. Now, when it comes to real estate itself, that has a specific formula. Tactics and strategies will change, but it's the fundamentals that always stay the same. It's all those basic fundamental things that need to always be addressed. I'm one that always looks at, instead of looking at cash flow, cash on cash return, I think that to me is the cherry metric. That's not your base metric. You need to be looking at the property's ability to stay reasonably rented the entire time you own it. Will it raise rents? And will it appreciate? And it doesn't have to be a lot. The main thing is, will somebody want to stay in that home or will they not? And if they do want to stay in that home, okay, then let's move on to the next thing. What fundamentals happen with that real estate that commands a person's interest and interest from multiple people and keeps yours rented? Then we're talking about the area, how well will it appreciate. As far as my appreciation, I only look at, I will math it out at about 2.5%. If I can average 2.5% appreciation for the entire time I own that property, I think I'm winning huge. Most people aren't looking at it that way. They want 4, 5, 6%. Now, if you get that, that's great. But to me, the bottom line is I want to see 2.5, sometimes 2, depending upon how much I invested. Now, then as far as the rents are concerned, if I can get 3% rental increases every year, kick ass. I got people looking at us like, I can't raise it by 8 and I'm not getting a cash on cash return of 14. It's not a good deal. People walked away from amazing deals for amazing cash on cash return that never ever materialized. It was all on the pro forma, which again we know is bullshit. Most of the time, to get the type of performance that they're looking for in a cash on cash performance for these so-called rent raise all stuff, you're going to end up buying someplace that's more of a C class, that's going to have mostly problems in it, and you can need every single cent of cash flow to go right back into the property just to keep it rentable. That's not a return. You just really turned yourself into a treadmill for some St. Louis shitbox.
Yeah, I was going to say C class might be kind for the type of ROI you're talking about getting there. But I think a lot of people, they look at that pro forma and they don't realize that there's a whole lot more years in 2 through 30 than there are in year 1. And I mean, what you're talking about, I mean, we did I think just the other day, you're talking about return on amortization, and we did it over, what was it, like 3, 5, and 10 years. Mm-hmm. And it was after 10 years just paying off the loan. If your property breaks even, I don't think we even did a single penny of appreciation. It was just straight principal pay down. And I think after 10 years, we were at, what was it, 12% a year?
Yeah, you're starting to really, really compound really, really fast just on principal pay down. People fail to realize how important that is. And let's just do the quick math ourselves right here. You know, if a person, and this is where down payment is a big deal. Amazing amount of people want to put 25 and 30% down because it gets them a better rate and a better payment, therefore better cash flow, correct? But they don't realize that you need a lot more cash flow than what you're getting to justify that extra money being locked up into one place. People don't realize exactly how returns work. They're so caught up in cash flow. Cash flow has become the main metric because it was the easiest way to sell real estate. So think about it this way. The people who pervade cash flow as your main thing and put that cash on cash return as the main metric to look at, no different than a car salesman that when you walk into the lot and say, hey, I want a red car, that's the only thing you're looking for. They're going to sell you the most expensive red car they have because it's the easiest sale with the most profit. The same thing with cash on cash. Well, I've got a pro forma that says you can get 14%, so it's a no-brainer. Well, what happens when it doesn't perform? None of the other stuff could perform too. So let's look at this from a perspective, $200,000 purchase price, right? And we're going to say 20% down, and we're going to say your costs are going to be somewhere in the range of $5,000, right? So You're putting 20% down on a property. How much are you putting down on a $200,000 house?
40, so you're all in for 45.
Yep, $45,000 all in. How much was the loan amount that you got?
You'd be at 160.
Exactly. It's amazing how many people think that it's 155 because you put 45 into it. Uh, so then we're talking about the amortization on this house. You got a $160,000 home, and if you did your job right as the real estate investor and the CEO of your investment business, who pays off the $160,000 loan?
Oh, we're gonna hope it's the tenant.
Yeah, because if it's not the tenant, then you weren't doing your job. Period. So 300 and sure, that's 30. So over 30 years, that's $5,333.33. Do we all agree? Now,
Sounds
this is
about
averaged, everybody. I know that you're going to say, wait a minute, there's an amortization table. No, this is the long game. We are literally playing 18 holes with a putter because we want to make sure everything hits exactly as we plan to. So $5,333.33 per year averaged over 30 years. But you invested $45,000, correct?
Yep.
So that means your return on investment is 11.8%. That means your $45,000 is increasing by 11.8% of that $45,000 every single year, averaged over 30 years. Where else is your $45,000 going to return that?
Yeah, and if another way to think about it, if you want, is that your principal payment is just more cash flow. I mean, you're going to get it on the end, but if you're really a cash on cash investor, and that's the most important metric, think about it as cash flow, and cash flow
that you don't risk grabbing and doing something stupid with. Think about that. We have stupid shit pops up in our minds that, oh, this would be great. I'm going to invest over here. Believe me, I know I have a portfolio of them. I've got well over $1 million of investments that are right now stagnant. Why are they stagnant? Because I invested in somebody's ability to run a great idea. I didn't invest in the great idea. I truly invested in the individual. And that individual sucks at running their idea. So who really sucks? Me for giving them the damn money to go and piss away because of their stupidity. It's the truth. So who's the stupid one? It's me. But look at this. You put it into real estate. It's one of the simplest things in the world to just at least maintain a payment. If you can keep a tenant in there, even if you didn't make a single dollar of cash flow, just the tenant eliminating the loan is putting an 11.8% increase that you can't tap into and do anything stupid with. That to me is a very, very safe bet. Now let's look at the appreciation. Is it reasonable to find that you can get a 2.5% appreciation year over year in a good market?
Oh, I would hope so. And this is why people, if you go on our website and look at our properties, we have a market summary of all the places that we're in to show you the numbers and the population growth and all the growth that will lead to the 2.5+% that we're expecting in all of these markets.
So 2.5+%. So 2.5% on 200,000 is how much?
$5,000, I think.
$5,000, and you divide that into your 45. What do you got?
I mean, that's another 11%, or no, 9%. Sorry,
it's actually more than that. So we're at 5,000. Divide that into your 45,000.
Oh, sorry. It is. Yeah, it's 1/9. So
it's 11. It's 11.1. So it's another 11. So now you're at basically it's 11.1. The other was you're 11.85. So you're literally sitting right on about 23% return just by putting money down. Just by putting in a market that appreciates 2.5, which most people won't do that. Like 2.5, that's crap. I want more than that. But guys, you're making 22% on your money, approaching 23.